Once you learn about turnkey investing and you start searching the internet for good turnkey properties to buy, you are probably going to find yourself overwhelmed at all of the options and choices that are out there. But it's important to remember there are a lot of bad turnkey deals out there. And not all turnkey providers are created equal. In fact, some of them aren't even providers. They're just marketers. They're just putting up listings of providers they've partnered with, and they get a commission on the back end. And a lot of them will say anything to make their listings look good. Some even offer educational programs, even free educational programs, teaching you about turnkey investing. But the advice and lessons that they give aren't necessarily going to be unbiased, because their goal ultimately is to sell their property listings. So it is super important that as you go on this journey, that you really take time to educate yourself, do your own research, and stick to buying criteria that is unbiased and based on data-driven analysis. In this video, I'm going to break down the 4 components of my buy right formula that I've personally honed as I built my portfolio to 6 properties and counting. When all of these criteria are met, you can pull the trigger and be confident that you are buying among the top 1% of properties that are available out there. Let's dig in. I'm Jim Bevins, a 30-year engineering veteran that pivoted my retirement to build a portfolio of rental properties that cash flows thousands of dollars per month. I'm here to show you how I did it and how you can too. So when we start talking about property analysis, there's 2 main branches that we go down. There's the financial analysis and there's the non-financial analysis. Now, the financial analysis, most people are familiar with. You know, I can talk about cash flow, I can talk about appreciation, and you're going to know what I'm talking about. Now, those are important, and I have a lot to say about them, and I'm actually going to in just a minute. But I want to start by talking about the non-financial aspect of turnkey investing, because it really is, I think, the most important when we're dealing with remote out-of-state properties that are, thousands of miles away from where we live. Because a big issue with the turnkey market today is that providers and marketers, the only thing they're really able to offer buyers to look at is a proforma, just the numbers. And so many buyers are just looking at a proforma and looking at the numbers and saying, well, it cash flows, so it must be good, right? Yeah, not so much. There is a lot more to buying a remote property than just the cash flow numbers. Specifically, I found that there are 3 main components that we want to look at, and I'm going to break them down for you in this video, okay? So the first one is who you buy from, okay? You want to buy from a reputable turnkey provider that does good quality rehabs. They have good property management in place that has good reviews from other investors, and you want to know that you're getting a good deal, that they're not selling you a property for more than it's worth. Now, the good news is that there are a lot of good turnkey providers like that out there. It's easy to find good quality turnkey providers that pass muster. There are a couple high-level things we can do to make sure that we're dealing with that. The first thing we can do is make sure that you're not dealing with just a turnkey marketer. There are national turnkey marketers out there. Like I said, they kind of act like realtors, right? They've approached these local turnkey providers and they've said, hey, I can sell your inventory for you. Just give me a commission and I will, take care of all the marketing for you. And that can work, but I have a few problems with that. The first problem is that you don't really get an opportunity to establish a close relationship with the boots on the ground of the people that are actually going to be dealing with your property. And you may eventually get there, but these marketers aren't exactly motivated to let you build that close relationship, because there's a fear that once you do, then you'll just start working directly with them and cut out the middleman and they won't get their commission, right? So that's one problem I have with them. Another problem I have with them is that you don't know how reputable or experienced, again, that boots on the ground turnkey provider is. There are horror stories of some of these marketers that are using, a relatively new provider that's unproven. And a lot of the problems that have popped up with turnkey properties is when that unproven provider runs into problems. They estimated their rent to be too high. They estimated their rehab costs to be too low. They charge more than what the property's worth. Things like that. And, these turnkey marketers can adjust to that and say, oh, well, they're no good, and they're just going to kind of cut them loose and go find new providers. And that happens pretty often. But you'll hear horror stories sometimes of people that are kind of the investors that bought from them are left holding the bag. And I've heard a lot of horror stories like that. And so I just like to rule out the national marketers completely. Just go straight to the actual turnkey providers and vet them and ask them questions and ask them how long they've been in business and what their experience is and so forth. So that's the first thing you can do to kind of narrow down making sure that you're working with a good turnkey provider, is just ask them, do you actually rehab and sell the properties yourself, or do you just market it for others? And if they just market it for others, I would move on personally. And there's some big examples like Rent to Retirement and Narada, but there's a lot out there. And so, I don't want to pick on any company. Just as a general rule, just ask them, are you an actual turnkey provider or just a marketer? Because I think it's important to work with that, boots on the ground turnkey provider. So establishing a good relationship with a quality proven turnkey provider that's actually active in the local market where you're investing, that's the first important key to buying right when you're looking for a good turnkey rental property to buy. But it's not the only thing. There are turnkey providers out there that I absolutely love. I would use them all the time if I could. And I recommend them to my students inside the Turnkey Mastery System. But even the best turnkey providers still sell properties in areas that I would never, ever touch. And that brings us to the second important key of buying right when you're searching for turnkey rental properties, and that is where you buy. Location still matters, right? This is real estate. Location, location, location. So before buying a turnkey property, you at least want to know a little bit about the area that the property is in. Now, you don't need to fly out and look at every property before you buy it. In fact, don't do that. That is severe overkill. But you at least want to know a little bit about the area. You want to know how old or new the houses are, if it's more economically depressed, and so forth. Now, the most surefire way to get an idea of what an area is like is to fly out and tour the neighborhoods and just make notes of like what zip codes have nicer homes, what zip codes are more marginal, and most importantly, what zip codes that you feel like, man, I need to get the hell out of here. I should not be here because it doesn't feel safe. And it's hard to describe that. There are areas like that where you just don't feel safe, But there's other areas that are more economically depressed, maybe more working class people. But you know what? There's toys in the yards, and you can see people riding their bikes, things like that. So that's the ideal way to get a handle on that. Now, barring that, and I acknowledge that is a big step to take to actually fly out and visit a market. Although once you do decide you're going to take this investing methodology seriously, like if you think you're going to build a portfolio and have multiple properties, ultimately visiting a market is one of the best things you can do. But if you're starting out, if you're not sure about this, that's a big step to take, is actually invest the money in traveling. And so the next best thing you can do is look for unbiased third-party descriptions of what the market is like. And that is actually why I created inside my Turnkey Mastery System, I created virtual buying tours, where I just go zip code by zip code of markets that I have personally visited and toured, and talk about all of the neighborhoods and what are the neighborhoods that I like, what are the neighborhoods that are pretty good. If there's properties there and they cash flow, they'll probably do good. And then there's other properties or other areas that are like no-go zones that I'm like, stay the hell away from there, right? So, and you can find some stuff like that on the internet as well. So you can look around and look for that kind of thing. You can also get input from turnkey providers and property managers. But again, be careful, because turnkey providers sell properties in areas that you might not want to go to. So you kind of want to take their input with a grain of salt. And so that is why I created these virtual buying tours, because it's like, here's the turnkey providers that are good, here's the areas that are good, and then when you intersect the two, you come up with a good, small list of high quality properties. So once you do that, you combine those two criteria. Now there's a third criteria to buying right that I like to factor into the equation to narrow down those properties even more. And that is the what that you're buying. What kind of property is it? What type of house is it? How many bedrooms does it have? How many bathrooms? And is it a house that's going to attract a quality tenant, right? Now, some areas, this is more important than others. If you're buying in like a newer grade A neighborhood that's like homes built in the 90s and 2000s and they're all nice houses, it doesn't really matter. You could probably buy anything there and it's going to be in good demand. But if you're in a more marginal area, a marginal B neighborhood or C neighborhood, then you want to make sure that you are standing out. If you just have a house that's just average like everything else, then you're kind of leaving it up to luck that you're going to get a good tenant. And what I like to do is look for houses that maybe have an extra bathroom or have an extra bedroom. Again, if you're in a more marginal area. So, there are some areas, for example, that might have like 90% 3-bed, 1-bath. That makes up most of the houses, and they're all built in the 1950s, right? And that's what was made in the 1950s. But you can find some that have like 1.5 baths or 4 bedrooms, and when you do, then that can sometimes have higher demand. And what that does is it attracts more applicants, which means that you have a better chance of whoever's at the top of the list is going to probably be a good tenant. And so that really just points to that the what of what you're buying, right? Now the way to determine this is just through simple research. This is actually something you can do yourself. When you start signing up for turnkey inventory and you start getting emails every week of properties for sale, you can start to kind of track zip codes, and I recommend like kind of keeping a little table of zip code of just like, how many 3-1s, how many 3-2s. And the other thing to look at is that as you are doing rental analysis and you're running the numbers on some of these properties, if you keep running the numbers in certain zip codes and you run the numbers on one that has like 4 bedrooms, or you run the ones that have like 2 bedrooms, and you see that the rent is consistently higher than the 3-bed, 1-bath, like by $100 or $150, then you know that is in higher demand. And so those are the ones you want to look at. I mean, not only are you going to get better tenants, but you're probably going to get better rent as well. So those are the 3 components we want to look at. We want to narrow our search to good quality turnkey providers that are active locally. And from there, we want to limit ourselves to only properties that are in good areas, or at least in areas that aren't in no-go zones, right? And then from within that, now we want to look for the properties that stand out and will be in high rental demand. And you can see that we narrowed down, and when you meet all of these criteria, you really do end up in that top 1% of properties that are available. And that's why you can sign up for emails from like 5 turnkey providers, and you'll be getting like 20 or 30 emails per week. But from that, there might only be 1 or 2 properties that you'll look at and you'll say, oh, yep, that's a good one. Or sometimes there's not any. Sometimes you might go a couple weeks before you find one, but when you do, it's like you're dialed in. You know that is a good property, and you move on it quick, right? So that's how I analyze the non-financial aspect of turnkey properties. And like I said, I think it's the most important aspect when we're investing in out-of-state markets. That's why I made it such a big focus of my turnkey mastery system. I provide done-for-you research that includes, my personal Rolodex of turnkey providers I like. I provide virtual buying tours of several markets that I've personally visited. And so that just really allows my students to just hit the ground running. So now that we've dialed in on the non-financial aspect of property analysis, let's pivot to the financial side, okay? It's time to look at the numbers. Now, the first thing I recommend here, just at a high level, is always run your own numbers. never go by the turnkey provider's pro forma. Now, you can use their specific expense amounts. Like they will tell you how much the property taxes are. They will give an estimate for the insurance. Those numbers are fine. You know, even if they're off by 10 or 20 bucks a month, it's not going to make a huge difference. So you can plug those numbers in, but they'll usually provide like a final result of like, it will provide X% cash on cash return. It will provide cash flow of X amount of dollars per month. It'll give you some number. And I just don't trust those. I mean, they're probably okay, but the problem is that there are different ways to calculate these numbers, and they all calculate them differently. And the whole purpose of running our numbers is so that we can run the numbers on property A from one turnkey provider, we can run the numbers on property B from another turnkey provider, probably, and we can run the numbers on property C from yet another turnkey provider, and we want to be able to compare them all. And if we're grabbing numbers from one and numbers from another and numbers from another, and they were calculated completely different ways, it doesn't do us any good. By running the numbers ourselves and coming up with the numbers ourselves, we can compare apples to apples to apples and make sure that we're getting the best financial return potential that we can, right? So, with all that said, let's start with the first main component of the financial analysis. Now, the financial numbers, it breaks down into lots of different vectors. There's lots of different things we look at, and I look at them all. But let's start with the most important and the one that everyone's familiar with, and that's cash flow. Specifically, day one cash flow. Like, as soon as you buy it, this is the cash flow you expect, okay? Now, there's actually 3 ways to calculate cash flow. There's actually 3 cash flow numbers. And again, I like data. I'm an engineer. I want data, and I like them all. I think these are all useful to know. So I calculate them all using my property analysis calculator. But let's talk about them. The first one is what I call raw cash flow, or maybe gross cash flow. It's basically cash flow after fixed expenses. That's it. So it's, you take the rent, you subtract the mortgage, the taxes, the insurance, and the property management fee. All of those, you know, you're going to pay every month. You know you have a mortgage. You know you have taxes. You know you have insurance. You know you have property manager, right? When you subtract all those out, that is your cash flow after fixed expenses. And this is a number that it may not be real over time, right? Because stuff happens. Tenants move out. You're going to, have maintenance issues. So it isn't reflective of the total cash flow you're going to get over any period of time, but it is what you can expect to actually get deposited in your bank account on most months. And so I find that useful to know, because most of the time, nothing happens in real estate, right? Most months, the tenant pays the rent, there's nothing to fix, and the property manager just takes out their fee and gives you the rent, and then from that you pay your mortgage payment, which probably includes taxes and insurance, and what's left over is yours. And that's the number that you want to calculate, because I like to know what I have, just after everything that I know about, okay? So that's the first number, is just that kind of that raw maximum cash flow, right? The second way to calculate cash flow now is we take that number and we subtract an estimate for variable expenses. Now, variable expenses, this is things like maintenance and vacancy, right? Now, those expenses, they don't happen in little equal bits month to month, right? They happen in big events. A tenant moves out, you need to make a couple mortgage payments, or you break a window, you got to pay $800 or something. So that's the kind of thing where to estimate that, we just account for some subtraction over time. What I like to do is I like to subtract 5% for vacancy and 5% for maintenance. So basically, from my raw cash flow, subtract another 10% of the rent, and that represents the average cash-on-cash return that you can expect over around a 1 or 2 or 3 year time frame, right? So it's over some moderate period of time. That's your average cash flow you can expect. Now, this number, this average cash flow, this is the main comparison number I look at. So if I'm looking at one property and I'm looking at a second property, I'm running the cash flow numbers. I am looking at that cash on cash return, and I'm looking at a percentage. In other words, let's say it's comes out to $200 a month times 12 is $2,400 a year. If I put, let's say my closing costs plus down payments, just to keep the math easy, let's say my closing costs plus down payment was $48,000. 2,400 divided by 48,000 out of pocket comes out to a 5% cash on cash return, right? So that's that property. Now another property, let's say I only make $175 a month net cash flow, average after all the variable expenses. But I put down only like 30,000. Then that 175 times 12 comes out to a number. Your percent cash on cash return might be more like 6%. So that percent cash on cash return is the main criteria I look at when I'm comparing property to property, okay? Now, there's a third component to cash flow, which I don't pay a lot of attention to. I like to kind of make a note of it and factor it into my total financial analysis, but that is factoring in long-term capital expenditures, right? Because if you own a property for 30 years, you're eventually going to have to probably get a new roof. You eventually might need to put in, to do some work on the pavement. You probably need to get a new HVAC or two, might need new flooring at some point. There's painting that's involved. So those are long-term expenses. Now, the great thing about buying turnkey rental properties, or specifically looking for properties that have been freshly rehabbed, is that a lot of those CapEx expenditures are way into the future. And so that's why I tend to not worry about it as much when I'm buying a turnkey property. I do like to factor it in, but I like to know the number, but it's not something that I pay a lot of attention to. But I want to make note of it. That's the third form of cash flow is now you take your average cash on cash after variable expenses, and then you add in another factor, like maybe another 5% for big CapEx items in the future. And that represents your average cash flow over like 10 to 20, even 30 years, right? So it's a useful number to know, but it's not super relevant because by the time you hit 10 years from now, the property will have appreciated. You'll have options to pay for stuff like that. You could probably refinance and pull some cash out. Or maybe you hit a point where you want to sell it and do a 1031 exchange into bigger investments 10 or 15 years from now. And so, you go ahead and put some money into it knowing that you're going to get a lot more out when you sell it, right? So that's why it's not as big of a component that I look at. Now, it's important to remember that cash flow is just one aspect of the financial return that we can expect from our real estate investment. In fact, there are 4 ways that real estate makes money for us, and I call them the 4 profit pillars, okay? This is what I love about real estate. These 4 profit pillars, I call them pillars because when they are all doing their part, they all add up to tremendous returns. And I'll show some numbers here in a minute. But sometimes one of them will falter. Maybe a tenant moves out and your cash flow takes a hit. Maybe the market softens and your appreciation isn't what you had hoped it would be. When that happens, the other profit pillars hold up the investment and make you win in other ways. And so that's why I think of them as pillars that are holding up your investment. So we already talked about the first profit pillar, cash flow. The other 3 profit pillars there's appreciation, and this is basically how much the property goes up in value over time. And it's important that we calculate this based on our actual out-of-pocket expense. So a 3% property value increase will actually be a lot higher increase relative to the down payment we put down because we use leverage, right? So the third profit pillar is principal paydown. So every time you make a mortgage payment, and you make a mortgage payment from your rent, right? So the tenant is basically paying your mortgage payment. Every time you do, you gain a little equity because that payment includes a little bit of principal. And so when you run the numbers through a mortgage calculator and you calculate how much principal you paid, that ends up being around 2.5% to 3% of the amount that you put down. And that's like a guaranteed 2.5% to 3% return, right? You're going to get that no matter what because you're paying the mortgage every month, right? The fourth profit pillar is the tax savings. And this is acknowledging the fact that any cash flow we get from this property is tax free. And the reason for that is because we can deduct depreciation. And so when we deduct depreciation, the depreciation is going to be more than the cash flow we have left after we pay all of our expenses. And so if you think about it, if you have one investment where you earn $300 that's tax free, and you have another investment that's worth $300, but you have to pay taxes on that $300, which one is more valuable? The tax-free one, right? That's worth more to you because you're going to end up with more money. That $300 that's taxed, you're only going to end up with $200. So the way to look at it is that $300 that's tax-free, that's as if you earned an extra $100. And so we can actually calculate that and say, you know what, whatever cash flow we calculate, we are going to factor in that it has actually boosted our real return. And you can calculate that. It comes out to usually about 1.5% to 2% additional return just from the tax savings, because all that money we're getting is tax-free. We're not paying taxes on it. We get to keep it. So those are the four profit pillars of real estate. And that is really what I love best about real estate, especially when compared to something like a stock. Because with a stock, you win or lose one way. If it goes up, great. If it goes down, you're hosed. And now you just got to hope and pray that whoever's running the show is going to turn things around, right? Or you just have to sell for a loss and look for a different investment. So I like that in real estate, we win in multiple ways. And if something falters, we're still winning. Even if you have a cash flow hit, I'm still getting that guaranteed 2.5% return from principal paydown. I'm still getting the tax savings and stuff like that. So, but I digress, okay? Now, the final aspect of the financial analysis I want to briefly touch on is I specifically mentioned day one cash flow. All these numbers we can calculate for that first year when we first buy it. But the real magic in real estate happens in following years. Because what happens is we bought this property using a fixed rate mortgage, 30 years fixed, right? Our mortgage payment will never change. And that is our biggest expense by far. Well, what's going to happen is in future years, inflation is going to do its thing, and rents are going to rise. Property values are going to rise, and your cash flow is leveraged, your equity is leveraged, and so any little increase due to inflation gets magnified over time. And that's the other part of the financial analysis I like to do is I like to look at what will the future years look like. Because it's very easy to look at a property and say, oh man, look at this awesome house. It's in an awesome A neighborhood. It's in a great location, a great turnkey provider. It's like 4 bedrooms, so it's going to be even a little bit bump in rent. It's the right kind of property. And you run the numbers, and then you look at the cash flow and you say, the cash flow isn't that great. But you know what? When you punch in some appreciation numbers and when you punch in some estimates for rising rents, the cash flow might not look that great today, but in 3 years or 5 years, it might be double from what it is now. And that's just because, again, of that leverage. The easiest way to illustrate this is to show you an example. So I'm going to bring up my property analysis calculator. This is the calculator that I offer to my students inside Cashflow Engineers. And it's a great way to just illustrate all these numbers really quick. Okay, so this is my property evaluation calculator. I call this my clarity calculator because that's what it does. It gives full clarity on all the financials of any property, both now and into the future, and it does it in literally seconds. I'm not going to go into a lot of details. I actually include this calculator as part of my Turnkey starter pack. And you can find a link to that in the description of this video if you want to go check that out. And along with that, I include a full video tutorial of how to use this calculator and all the different features and functionality it has. So I'm not going to repeat that here. So check that out if you want to do more of a deep dive into this calculator and get a copy for yourself. But what I want to do here is just flash up some numbers to just illustrate the concepts that I've been talking about in this video in terms of the 4 profit pillars and projecting, our cash flow and appreciation out into the future. So I've already entered a turnkey deal. This is a real turnkey deal. It was from a couple months ago, but it was an actual property that was for sale that I punched in, and it's fairly representative of a typical deal. It's not a great deal. It's pretty good. It kind of meets my minimum requirements, but it's fairly typical of what you can find out there. So I already put in the price, I put in the rent, I put in the interest rate. I'm assuming 20% down payment. It calculates how much the down is. I put an estimate for closing costs, usually $5 or $6 grand. It calculates a mortgage payment, and then I punch in all the fixed expenses we talked about: taxes, insurance, property management fee, and then I put in an allowance for variable expenses for vacancy and maintenance, and I use 5% each. And then I even put in an expense ratio, and this is how I come up with the long-term capex. This doesn't really. That's a whole nother explanation. I'm not going to get into that here, but we do account for it. There's a couple ways we can account for that. Really, what I want to do though is just kind of show this is the if I move this over. Let's see, make sure I'm centered on my screen here. Then you can see this result here. This is what I refer to as that raw cash flow, right? So this is after fixed expenses. And then when we take away variable expenses, we're left with about $150 a month. Again, this is average over 1 to 2 years, taking into account that money for variable expenses. But you can see that this is, when we take 150 times 12, and then we divide that by our down payment plus closing costs, it comes out to a cash-on-cash return of about a little over 5%. And 5% is kind of the minimum that I shoot for in this market with the current rates. You can usually get between 5 to 7%. If you can get into 7-8% range, then it's going to be usually is a really good deal. So this falls in that range. But you can see that the one thing that this calculator has is I'm putting in assumptions for appreciation, annual rent increases, and the annual inflation rate. And so obviously these first two help us. This means that the rent is going to appreciate 3% per year, and this means that the property value is going to appreciate 3% per year. And then inflation, this means that our expenses, the taxes and insurance, this is also going to increase 3% per year. So this will be a little bit of a drag on our net profit. But I factor all those in, and you can see that when I expand here, now we can look out into future years, and it does this math for us. And the main thing I want to show is you can see that in year one, our total 4-pillar return, when we take the 5% cash on cash, the 3% property increase, means that because we only put 20% down, that's a nearly 12% return on our down payment. And then the principal mortgage paydown, that's like a guaranteed, usually 2.5 to 3.5%. So this is showing a 3.5% return on our down payment. And then the tax savings is just, again, indicating that this is the additional return boost, because this $150 a month, this is tax free. So you add that all up, and the total 4-pillar return comes out to a little over 22%. One thing I do, I subtract the long-term capex from appreciation, and you can see here that when I check this box, it affects the appreciation. I can also subtract it from the cash flow, but I don't like to do that for a turnkey, because you're not going to see anything from this for 10 years, because everything should be, all the systems are new. So I subtract it from appreciation. It's a whole nother explanation that I get into in the tutorial for this, but just again I'm all about being data driven, and I want to account for everything, every last little thing in my analysis, and so it still comes out to a little over 20% total return in year one. But what's interesting is that if we look in the future years, that is where we really start seeing some interesting things happening. Now, you can see here that the rent's only increasing 3%. Okay, and to a tenant, a 3% rent increase is, maybe only like $30 or $40. And you can see here that, but because our mortgage is fixed, that goes straight to the bottom line. And this means that our net cash flow increases from 150 to 180. Now, You may look at that and you think $30, $30 increase. How, is that really a big deal? Well, considering that we started at 150 and we went to 180, that's a 20% increase in our cash flow in 1 year. And that's the thing about cash flow, is that we're going to start small, but the growth is very fast. It grows very fast. And you can see here that what's going to happen is by about year 6, if I can get this scrolled over a little bit, there we go. Year 6, we have doubled our cash flow in 6 years. So before we were getting 150, now we're getting 300. And then the raw cash flow, that max cash flow after just fixed expenses, that's up there. That's approaching nearly $500 now. And by this year 6, if you've got one property every year, then you can start to see how, okay, this one you got 500 after fixed expenses. The one you bought the year prior, maybe it's at like 400 after fixed, 450 after fixed expenses. The one you bought the year before that, it's like at 420 before fixed expenses. And obviously all these numbers are different, but you can see how it starts to stack. And every time you buy a property, then you start climbing the ladder, and the cash flow starts rising with inflation. So I just wanted to point that out. You can see how the return, the 4-pillar return, keeps getting bigger and bigger, because again, that it's, even though it's only 3%, that's still 3% compounded, right? So, and you can punch in your own numbers. You can, use your own estimates for inflation and rent increase, whatever. 3% is just a good baseline I'm using as an example. So yeah, that's what I wanted to show, is just how it's that year 1 cash flow in financials isn't really the most important thing. I mean, $150 a month, you look at this and you think, is that really going to move the needle? Well, the thing is that we're not buying this for year 1. We're buying this for what it will get us in future years. And so, by year 10, you're approaching $500 a month after all expenses, right? And after fixed expenses, you're approaching $700 a month. And again, if you stack these one on top of each other, if after 10 years you've got 10 houses, you're looking at thousands of dollars per month in passive income. And that's what this investing methodology is all about. So now that you know what all is involved with properly analyzing a turnkey rental property, how to run the numbers, how to make sure that you're looking at the top 1% of available properties, the next step is to look at the mistakes that I've seen people make and the mistakes that I have made myself and to help steer you clear of making those same mistakes. There are a lot of horror stories out there of turnkey investing gone wrong, and I don't want anybody watching my channel to fall into those same pitfalls. So keep watching. In my next video, I'm going to go over the most common mistakes that I have seen other investors make and that I've made myself. And I'm going to go over how you can avoid falling into those traps yourself. Okay, so keep watching. You won't want to miss this one.